Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Rockwell Automation, the company turning factory floors into intelligent, connected, software-driven production systems.
Rockwell Automation traces its roots to 1903 in Milwaukee, Wisconsin. The Allen Bradley brand, acquired in 1985, became the gold standard for programmable logic controllers in North American manufacturing.
Rockwell was spun off from Rockwell International in 2002 as a pure-play industrial automation company. That focus has defined the strategy ever since. No diversification, just automation deepened over decades.
Today, Rockwell operates three segments: intelligent devices, software and control, and lifecycle services. Together, they cover the full automation stack, from sensors on the factory floor to cloud analytics.
Intelligent devices includes drives, motion systems, safety equipment, and configured-to-order hardware. This is where Allen Bradley's legacy product lines live and generate the majority of hardware revenue.
Software and control includes FactoryTalk MES, control and visualization software, and digital twin simulation tools. This segment is growing faster than the hardware business as manufacturers adopt cloud-connected manufacturing.
Lifecycle Services provides consulting, professional integration, and ongoing connected maintenance. It is the fastest-growing service business and drives recurring revenue that smooths the cyclicality of hardware orders.
The economic moat rests on the Allen Bradley installed base. Millions of PLCs running on Logix architecture are embedded in factory control systems that cost tens of millions to replace and recertify.
FactoryTalk deepens that moat. Layering MES and analytics software onto the same hardware platform creates subscription revenue and makes the overall system harder to remove than the PLCs alone.
Adjusted earnings before taxes run at margins around 18%. Gross margins sit at roughly 44%, benefiting from the growing software mix that carries structurally higher contribution margins.
CEO Blake Moret has led Rockwell since 2016, spending his entire career at the company. His strategic focus has been the software and services transition, accelerating recurring revenue as a percentage of total.
Rockwell has increased its dividend for 14 consecutive years. The annual dividend of approximately $5 per share yields around 1.1%, consistent with the industrial compounder peer group.
The 2018 PTC partnership brought industrial IoT software into the Rockwell ecosystem. Vuforia and ThingWorx complement FactoryTalk for connected factory applications.
Customers span automotive, semiconductor, food and beverage, life sciences, and process industries. No single end market dominates, providing resilience through manufacturing sector rotations.
The principal competitive threat is Siemens and ABB globally, and Honeywell and Emerson in North American process automation. Each competes on the software layer.
Rockwell's North American market position is a structural advantage. Allen Bradley commands dominant installed base share in U.S. and Canadian manufacturing.
The long-term thesis is factory digitization. Every automotive, semiconductor, and food plant in the world needs to automate more, and Rockwell is the incumbent at the control layer of that transformation.
Intelligent devices plus software and control plus lifecycle services. Hardware moat, software stickiness, and growing recurring revenue. That is the Rockwell flywheel in three segments.
That is the Rockwell Automation chapter. Factory intelligence is the destination. Rockwell has been building toward it for over a century.
The quarter is loaded. The numbers are ready. Let us break it all down now.
Rockwell Automation crushed Q2 fiscal 2026 and raised full-year guidance meaningfully. Adjusted EPS of $3.30 beat consensus of $2.88 by 14.5%. Adjusted EPS up 32% year over year. Revenue of $2.24 billion grew 12% reported, 9% organic. Software and control segment grew 20%. This is Charged Alpha. Let's break it down.
For context, Rockwell carries a market cap near $44 billion and trades at 30 times forward earnings. The business operates through three reporting segments: intelligent devices, software and control, and lifecycle services. The headline question Wall Street is asking: can the software and control flywheel sustain 20% growth and continue expanding margins?
The headline beat had layers. Adjusted EPS of 330 represented 32% year-over-year growth from 250 in the prior year quarter. Revenue of $2.239 billion grew 12% reported and 9% organic. Currency translation added 3 percentage points to reported growth. Core performance contributed 80 cents per share of the EPS beat.
Software and control was the clear standout. Revenue of $684 million grew 20% reported, 17% organic. Operating margin expanded 480 basis points to 34.9%. This segment houses FactoryTalk MES, control software, and digital twin tools, and it is the structural growth engine of the franchise.
Intelligent Devices revenue of $1,008 million grew 13% reported and 9% organic. Operating margin expanded 320 basis points to 20.9%. This is where Allen Bradley's drives, motion systems, and configured-to-order hardware live. Pricing, volume, and product mix all contributed positively in the quarter.
Lifecycle Services revenue of $547 million grew 2% reported but declined 1% organic. Operating margin held at 14.6%, flat year over year. Importantly, the book-to-bill ratio of 1.07 indicates growing backlog despite the muted current quarter revenue. Forward visibility is improving.
Operating margin discipline drove the beat. Total enterprise operating margin expanded meaningfully on volume leverage, favorable price-cost dynamics, and continued mix shift toward higher-margin software. Software and controls near 35% operating margin demonstrates the structural profitability of the digitization business model.
Free cash flow was $275 million in Q2, a substantial step up from $171 million in the prior year period. Cash conversion improved with operating leverage. Management expects approximately 100% free cash flow conversion of adjusted income for the full year, an attractive cash generation profile.
Customer momentum spans automotive, semiconductor, food and beverage, and life sciences end markets. The factory digitization secular trend benefits Rockwell across all of them. Allen Bradley's installed base position in North American manufacturing creates significant pull-through for software and control as customers modernize control systems.
CEO Blake Moret has led Rockwell since 2016, spending his entire career at the company. His strategic focus on the software and services transition is now visibly paying off. Software and control segment revenue and margin expansion are the most direct expression of that strategy. Moret is widely viewed as the architect of Rockwell's digital reset.
Capital allocation continued through the quarter. Rockwell raised the dividend for the 14th consecutive year, current annual yield approximately 1.33%. The dividend payout ratio sits near 40%, leaving room for continued capital deployment toward bolt-on acquisitions and digital platform investment.
The most important update was guidance. Rockwell raised full-year fiscal 2026 adjusted EPS guidance to $12.50 to $13.10, from a prior range of $11.40 to $12.20. Revenue growth guidance was raised to 5 to 9% from prior 2 to 6%. The midpoint EPS raise of $1 reflects high conviction in the back half.
Valuation reflects the renewed enthusiasm. Rockwell trades at 30 times forward earnings, a meaningful premium to the broader industrial complex. Price to sales of 5.2, EV to EBITDA approximately 19. Beta of 1.5 reflects the cyclicality of manufacturing automation balanced against the secular software thesis.
Wall Street's positioning was cautious heading into the print. Consensus rating is hold. The breakdown is approximately 9 buys, 12 holds, and 3 sells. The average price target sits near $4.25. Several firms have moved more constructive in recent months on the digitization thesis. The post-print reaction may trigger broader upgrades.
Forward EPS for fiscal 2026 is consensus near $12.85 per share, within the new guidance range. Revenue around $8.95 billion at the midpoint. The setup for fiscal 2027 implies further compounding to $14.50 EPS and over $9.4 billion in revenue. The trajectory is solidly positive.
The bull case rests on 3 pillars. First, the software and control flywheel, 20% revenue growth, 17% organic, 34.9% operating margin, This segment alone justifies a higher multiple than the overall company carries. The factory digitization secular trend is multi-year, and Rockwell is the North American incumbent.
Second, guidance raise quality. The full-year guide raise reflects already booked backlog plus operating leverage at the margin. Lifecycle Services book-to-bill of 1.07 validates the forward demand picture. The setup for the back half demands continued execution, but is supported by hard order data.
Third, capital allocation discipline. 14 consecutive years of dividend growth, free cash flow conversion approaching 100% of adjusted income, and a balanced approach across dividends, share repurchases, and bolt-on acquisitions. The capital return profile is attractive for a structural growth franchise.
The bear case starts with valuation. At 30 times forward earnings, Rockwell trades at a premium to historic average and to peers like Emerson and Honeywell. Any deceleration in software and control growth or margin expansion would compress the multiple. The premium demands continuous execution at every step.
Second concern, Lifecycle Services softness. Organic revenue declined 1% in the quarter despite the improved book-to-bill ratio. If services project timing slips further, the segment could remain a drag on consolidated organic growth. Services historically lead manufacturing capital equipment cycles, so the softness deserves attention.
Third, currency tailwind. 3 percentage points of reported revenue growth came from currency translation. If the US dollar strengthens, that tailwind reverses. Rockwell would need to rely entirely on organic growth to maintain the new top-line guidance, raising execution sensitivity for the back half of fiscal 2026.
Rockwell's competitive set is global. Emerson Electric, EMR, is the closest North American process automation peer. Honeywell, OWN, competes on industrial controls and connected industrial. Siemens dominates European industrial automation. ABB Group is the Swiss multinational competitor. Eaton, ETN, overlaps in industrial electrification, but with different end markets.
Versus Emerson, Rockwell has stronger discrete automation and PLC market share, while Emerson is stronger in process industries and oil and gas. Both have been transitioning toward higher software content. ROK trades at higher multiple for sharper software and control growth profile. EMR offers more diversification across process industries.
Versus Siemens and ABB, Rockwell is geographically narrower, but commands the dominant North American installed base. The home field advantage is meaningful. Switching from Allen Bradley PLCs to Siemens architecture requires recertification and carries operational risk that most North American manufacturers avoid. That advantage is structural.
Options activity around the print was constructive. Put-call ratio below 1 reflects continued call buying ahead of the guidance raise. Implied volatility moderated post-print as the operational beat and software and control margin expansion reinforced the long-running automation digitization thesis. Options market positioning improved meaningfully.
Bottom line on Rockwell Automation. This was a clean quarter with a meaningful guidance raise. Software and control delivered 20% revenue growth and 480 basis points of margin expansion. Intelligent devices grew 13%. Free cash flow doubled. The digitization thesis is playing out exactly as Blake Moret has positioned the franchise.
For long-term investors, Rockwell at 30 times forward earnings demands continued execution. Track software and control organic revenue growth and operating margin sustainability as the key indicators. The factory digitization secular trend is multi-year, and Rockwell is the structural North American beneficiary at the control layer of that transformation.
Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.